Hey everybody, welcome to Sum Zero. We are back with Ben Axler to talk about what I think is his largest ever activist shorts campaign on a company called Stryker, ticker SYK. Ben, Stryker is a little bit of a darling in the medical device industry. I mean, I remember when I first started investing, Stryker was almost unimpeachable. It was kind of one of these companies that would always trade kind of close to 20 to 25 times earnings, growing EPS kind of almost in a metronomic fashion. And obviously the market cap has expanded significantly over the last decade to what it is now, which I think is over $100 billion with an enterprise value of $120 billion. Let's dive in. I think having read your report now on Sum Zero, some of the more salient points, to me at least, were margin compression due to some of the supply chain problems they're facing. But also, I think even more concerning is some of the top line pressure that you claim they've been experiencing. Some of which may have to do with COVID. But can you just talk about, kind of at a high level, what's happening with the business? Where are they seeing headwinds, and what are they doing about it?
Yeah, so look, what do we like about Stryker as a short? I mean, Stryker is a massive roll-up, and roll-ups can do really well for investors that get in early. Uh, right after the financial crisis, 2009, you look at Stryker, they had very little debt and about $3 billion of surplus cash. They brought in a new CEO, and they took advantage of the opportunities that were in front of them, and that was cheap capital, an underlevered balance sheet, and plenty of targets to diversify, their business in the orthopedic and neurotechnology space, and that produced an enormous amount of gains. Fast forward to today, the story is a little bit different. Now you have a $100 billion company with, we believe, more than $16 billion of debt that swallowed a tremendous amount of acquisitions, and its size is now impeding its growth. Its core, talk about what do they do today? Well, I mean, they still have a core, orthopedic, product set to serve knees, hips, and spine. Some of these businesses are better than others. We think the spine business is particularly problematic. They compete with players such as, Zimmer, which recently actually spun off its business, recognizing that it has a high cost structure and different and low growth prospects. Stryker, instead of fixing their spine business, they doubled down on it. They bought a business called K2M Group, which we picked a tremendous amount of holes in. And now they're reclassifying that business, realigning segments, we think, why, to bury the bad problems there. Look, the product set in general in aggregate are in deflationary categories. And, we can talk about the macro backdrop, obviously with slow growth and a Fed, destined to raise rates. I mean, we want to be short companies with no pricing power, with over-levered balance sheets and poor business prospects. And that's Stryker. We can talk about specific acquisitions and things they've done.
So before we get into that, just to zoom out a little bit, when I look at the multiple on the name, I'm seeing a forward multiple based on Wall Street consensus of around 27 times. I take it your view is that those estimates are just wrong. And you would expect earnings to come in materially less than what Sellside consensus is on the stock because of some of these issues you bring up, like poor acquisitions and cost inflation, pricing problems with top line and all that. Is that a fair assessment, that you just think the estimates are wrong?
Well, I think you have to really dig deep and to really understand what are their earnings per share. Okay, one of our big problems with this company and why we think they're exhibiting many and we can talk about the multiple, if not every single classic red flag sign, is that their earnings per share is not what it really should be. I mean, they're portraying a heavily adjusted non-GAAP earnings per share, and what we see is that the divergence between GAAP and non-GAAP, whether it be on EBIT or gross margins or earnings, keeps getting wider and wider. We think the core sort of earnings here is very low single digit. And do we think they're going to miss numbers? Yes. I mean, I think where we really have a concern and what we really focus on is the cash flow. Okay, the earnings, companies can manipulate earnings a million different ways to make them look good, and we've laid out how Stryker has been changing their inventory accounting methods, how they've been stretching out their depreciation period, how they've been playing with tax rates to make them artificially low. So the earnings look great; they look like they're growing, but what's happening with the cash flow? And that's where we really dig in. We look at the inventory and some of the games they've been playing. As part of our research, as you know, we don't just look at the numbers. We also talk to former employees knowledgeable about the business. So we have interviewed people in the M&A function, in the supply chain function, and technology function. And one of the key themes that we learn is the companies have historically problems managing inventory and problems accounting for it. Some of it is just how the business works. Some of it is just that they don't have the systems in place to accurately track this stuff. And so when you look at the inventory, what we think part of the problem here is, Divya, is that they never managed it well, and they had a lot of excess inventory going into COVID, and they really got caught flat-footed because 50% of their business was tied to elective procedures that could be deferred. And so what they decided to do is work down excess inventory, and now they're short. Now they're short inventory, and also during COVID they deferred a lot of the CapEx. You can very plainly see that they didn't hit their CapEx targets. They deferred it. And so what does that mean is that that CapEx is going to, they're eventually going to have to invest that CapEx, which we think is going to then pressure the free cash flow going forward. And then, of course, with the inventory, with them being short inventory and having really messed up supply chain efforts with inflation, they're caught in a margin squeeze because, as we said, core products are going down, and their core input costs are going up. So that's a margin squeeze. Cash flow estimates have been coming down. You can see that clearly. If you look at Bloomberg, you type in the the EEO function, you can see that slowly the cash flow estimates are coming down, but we still think they're too aggressive. We think it's very likely that cash flow declines this year for a second year in a row. And yet, of course, you have the company's equity trading at an all-time high multiple. There's a huge divergence here, which is why we think this is a highly asymmetric short.
What would you say from a competitive standpoint is the biggest risk here? Is it Johnson & Johnson? Who's kind of like causing the most damage from a competitive standpoint?
Yeah, so this is where the rubber hits the road. I mean, the company has sort of one star in its portfolio, and that is Mako Robotics. And they bought Mako Robotics, which the shorts hated, heavily shorted name. The shorts got toasted years ago in this name. They paid about $1.6 billion for Mako. And this is a robotic system, mostly focused on, knee surgeries. And they have some hip, but really knee surgeries. And they got off to a very slow start, admittedly. As with most of the acquisitions, Stryker has a history of letting investors down very early. They did that with Mako. Mako got approved for a total knee procedure. There was a big uplift in the business. To their credit, they stuck with it. And Mako ended up being a pretty good business. They don't cleanly disclose the numbers here, Divya, but we estimate this could be $1 billion business in their $17 billion total portfolio. And what the story here with Mako is, which is not being told by management, but deflecting issues about competitive nature, is that whereas they used to be able to sell these robots for about $1.5 million, and then they would generate a service contract and a consumable, Zimmer has come into the market with their Rosa robotic. J&J is now on the market with the Velis system. So now you have two new competitors. And what we found, to our surprise, was that players such as Zimmer are giving these robotic systems away, in placement deals, in some cases at no upfront cost. So if you're Stryker and they claim to have sold 300 of these units, imagine getting $1 million a pop or $1.5 million a pop at 300 units. That's a $300 million nice revenue, cash inflow day one type of business. Now all of a sudden, You come in and you're up against Zimmer, who's giving them away at no upfront cost. Well, geez, that's a big hit. That's a big hit to your business, and you have to get a little bit more creative in terms of how you finance these things. So this is the untold story, that management's in denial. And Spruce Point, we've heard this before. Don't forget, one of our best shorts of all time has been iRobot. Robotics, again, technology, whether it be medical technology or consumer technology, are deflationary over time. Competitors replicate the products, and it was the same story with iRobot. iRobot kept saying, "Oh, we see competition, but it's good. It validates what we're doing, and the whole market's growing, and competition's good for us." And it's the same story that Stryker's spitting with Mako Robotics. But ultimately, their margins are getting extremely pressured here, and what once was a lucrative business, is less lucrative, still growing, maybe not as fast as it was, but definitely under pressure.
So Ben, I hear you on the Mako acquisition and maybe how some of the margins there are eroding. Let's talk about acquisitions overall. I mean, you mentioned in the beginning this is a roll up. Like roll up is almost part of the DNA of Stryker, and so you'd think, that would be something they would be very good at. But reading your report, it sounds like they've at least more recently been making really bad acquisitions. Like, what do you think is driving that? Is it just has it just been hard for them to find cheap? I mean, obviously, biotech and medical devices is a pretty expensive category from a valuation standpoint, but what have they been screwing up here from an acquisition standpoint?
That's a good question. So look, I mean, every company, every roll-up eventually hits an inflection point where its size is its inhibitor, right? Stryker, now a $118 billion company with $18 billion of sales, has to find targets that can move the needle in a world where, by the way, valuations are still pretty expensive. And so, what we find, by analyzing their acquisitions, but also by talking to someone, a former employee with knowledge of, how they approach things, is that there's a tendency to overpay for businesses, overpay and not walk away and not be disciplined. And the Stryker name now in the marketplace has a little bit of a premium attached to it, because once you get that reputation of overpaying, and you find out that Stryker is interested, you can kind of get more money. You can get more money out of them, and that's kind of what's been happening. There's also competition, as you know, these corporations have various divisions, and there's competition within divisions to pitch, M&A within a big corporate. And so, what you find is sometimes internally expectations are set too high to sell a deal, and then once the deal closes, and you've overpaid, then you realize, well, some of the expectations were too high. And I think you can see it very clearly in the Wright Medical acquisition, which they did. You can see it very clearly in the K2M group, acquisition, that the estimates in terms of the growth rates predicted for these businesses just haven't panned out. But what we also really think is that there's been an extreme lapse of due diligence. I mean, we really dug deep into the K2M group acquisition. Now, this was a public company. They paid over $1 billion for in the spine business. And, if you did a little background check on management of K2M, you would have seen that the chief accounting officer and the CFO were very much involved with the InPhonic scandal a number of years ago, a company that blindsided investors with 6 material weaknesses, and ultimately went bankrupt. Well, guess what? Some of that management team, that InPhonic management team that landed at K2M, we think they kind of hoodwinked Stryker. Why? Because we found evidence in foreign filings of inventory, qualified opinions on inventory. That's, getting back to the inventory, obviously we've seen a pattern with their acquisitions of them marking up inventory valuations pretty high, only to then run through their income statement non-cash step-up adjustments to inventory. And we have a whole analysis. We can't reconcile, what exactly they're doing there, but it could be one means of flushing, expenses through as non-cash and having investors ignore that, because Stryker's never taken an inventory write-down. And then lastly, I'll say, with the acquisitions, Divya, look at the Goodwill. The company has an enormous amount of Goodwill.
I was just checking it. It's almost $13 billion of Goodwill as of December 21. I mean, what's the impairment risk on that?
Extremely high. I mean, again, we have two key evidence points that that they are not impairing goodwill. Number one, again, in their foreign filings, we found in their UK filings that they impaired their UK ear, nose, and throat business. Well, guess what? Like, why didn't that make it onto your consolidated statements? Why are you impairing goodwill in the UK, but not at the consolidated level in the US? So there's clear evidence of accounting shenanigans right there. Number two, as part of the Right Medical deal, the government required them to divest a business, and they divested a business called Star Ankle, which they had bought in an asset acquisition 10 years earlier and paid something like $300 million for. We could not find when they divested it how much they got for it. If you look on the cash flow statement, there's no line item for proceeds from divested businesses or divested assets. And so we think that business actually was problematic. Why? Because there was an FDA recall shortly after they divested it. So we think there's a high probability they got zero, as in $0 for a business that they paid hundreds of millions of dollars for. And again, never recorded goodwill impairment. So yeah, we think that there's definitely clear issues here on the goodwill side. And we posed the question to management: how is this? Number one, did you get nothing for your Star Ankle divestiture? Because we can't find any evidence of cash inflows on the financial statements. And and number two, why are you impairing goodwill in foreign markets, but not at the consolidated level, in the SEC filings?
You had mentioned earlier that they had made something like a $400 million acquisition, or $400 million in acquisitions, but in exchange for only $1 million of EBIT. And it just got me thinking, like, what is their core, like, what would you say is their best source of like stable revenues and profits? Like, if you were to kind of carve out all of the stuff that maybe it was more speculative, what's left that you can bank on that you could then value as being sort of somewhat stable, somewhat reliable, maybe less susceptible to new competitive threats? Like, do they have dominance in any one area of medical device where they're not necessarily seeing ruthless competition to drive down pricing and reduce margins? Or like, where do they have something a little closer to a steady eddy that could serve as a base case for the business?
I mean, if they have it, we can't find it, right? And again, I think part of the perception here is that this is a defensive company, right? It's in the healthcare space, but there's nothing defensive about it. And part of the issue we have is that the company delayed, and this is why we think they're ultimately delaying bad news to investors, and we have evidence of it. I mean, during COVID, they waited months, maybe until I think May, well after the WHO declared the pandemic, to tell investors, oh, by the way, 50% of our sales are tied to elective surgeries. And, these are discretionary surgeries, such as, oh, I have knee pain. And my doctor says, well, you can live with the pain, or you can get a knee replacement. And most, there's been a lot of studies on this. Most people say, I'm going to delay getting surgery, right? I'm going to see if I can live with the pain first. So, a lot of their products go into situations like this where, people just decide to delay it. And maybe there's this perception now that we're getting out of COVID and there's huge pent up demand. And that's going to maybe backfill some of the problems, and it may or may not. But we still think obviously the valuation is extreme, and the core cash flow continues to suffer. And the debt's not going away, and the debt load is where it is. And despite the company even suspending stock purchases, right, to conserve cash, it's going to take them a number of years to pay down debt for their most recent acquisition, Vocera, which we can also talk about.
Just getting the cash flow, what is the free cash flow yield of the business right now based upon like your free cash flow estimates, roughly?
So we have that, sorry, on slide 257. Yeah, I mean, we think the cash flow is about 2.1 billion. now bear in mind, we also make a further adjustment to the cash flow. Why? Because the company has to buy back stock to offset, tax issues related to compensation programs. They put that through the financing section. We think that that's not really a financing cash flow because it's tied to employee compensation. So that's about $115 million nut for them as well. Plus, the street continues to underestimate CapEx. Again, the company's already delayed some critical CapEx 2 years running now. The company's put out a $650 million CapEx estimate. The street still seems to think it's going to be less than that. So the street's at, like 2.8 billion, and we think it's going to be dramatically less. We think it's going to be closer to 2.1 billion. And it's going to be a second year of decline in free cash flow here, and the market just seems oblivious to it all, or willing to give them a pass and hope that it's temporary. But we think some of it's structural, right? I mean, the prices, the deflationary forces in their prices are year after year, and the Mako, as I said, the Mako situation, that's not getting better. It's not going to go back to them getting $1.5 million per robot like they could get 10 years ago. These things are structurally changed, and we think the business has gotten structurally worse, not better.
So, assuming your 2.1 billion is roughly correct, I guess that translates to about a 2% free cash flow yield for the business. You think that it should be more like a 4% free cash flow yield, so you get to like a 50% stock price drop? Or what would you say is a fair? And I'm curious where the comps are at in terms of their free cash flow generation. Or if you want to look at it on a PE basis, that's fine too. But I'm just curious how you think about this versus comps.
Yeah, I mean, the comps, which we have on slide 193, traded 20 times EV to cash to operating cash flow. In our estimate, Stryker's trading at 40. So I think there's a tremendous amount of froth in this stock. We have it trading at 6.5 times revenues. Again, I don't think the street has the right debt numbers. I mean, we should talk about that because we've made a lot of adjustments to the debt. Not only do they have financial debt, but they have unfunded employee compensation programs, they have operating leases, they have accrued tax and interest penalties. Now, that's something we also flagged. As we said, we think the company has a very aggressive tax structure. Last year, their top tax professional, their VP of tax, left the company. I believe he might have been an executive. They didn't file an 8K on that, but he left. They also just lost a patent lawsuit against Becton Dickinson for another 30 million. So you got to make all these adjustments, and then they took on more debt from Vocera. So we think the real debt, if you were to look on Bloomberg, you might see it's like 12.9 billion, but the real debt's more like 16.3 billion. And the cash, again, you got to look carefully at the cash, Divya. The company has a tremendous amount of cash trapped abroad in foreign markets, which they cannot use to delever. It's permanently invested there to grow their business abroad. So, their cash available for debt repayment is, really on the order of 1.4 billion. And so, we think the leverage is pretty high. We're talking about 5 times leverage for a business in a margin squeeze right now, trading at the industry high multiple. There's a clear disconnect here.
Yeah. As far as the debt goes, is most of that kind of like fixed coupon, longer term debt, or what do the maturities look like on the debt? Is anything coming up that could become a problem for them from a liquidity standpoint?
I mean, they have some unsecured debt coming due in 2023. They took out a term loan with Vocera 2025. They say that they're going to pay that down rapidly. And by the way, that's part of what we like about this as a short right now. The company is a little bit handicapped, right? I mean, they have to pay down this term loan. They're not buying back stock. They can't do another big acquisition. They've claimed they may do some tuck-ins, and we've done some analysis of even their tuck-ins have been problematic. They've been buying little rinky-dink companies with FDA problems. We go to the MAUD database in the FDA website, and you can look to see some of the products that they have, which have generated a lot of complaints and problems post Stryker acquiring them. So why do we like this as a short? Number one, it's not a crowded short. It's only 1.5% short interest. There's no cost of borrowing the stock right now. It's like 2 basis points. It's a non-consensus short, right? Nobody's really done the work until we laid it out in 190 slides. It's easy to hedge. Why is it easy to hedge? Because it's in the S&P 500. It's in the XLV ETF. It's in the IHI, very liquid ETFs. And we think at best case, the stock is going to trade up a few points because over time, if they are successful in deleveraging, they'll pay down this $1.5 billion term loan. But there's hundreds of millions of dollars outstanding. I'm sorry, there's hundreds of millions of shares. So there's only a few points of accretion from deleveraging here. And that's another point, by the way. We think the street has structurally also mismodeled the share count. I think the street has the share count declining, which doesn't make any sense to us because they're not buying back stock and they are issuing stock to employees. So the street doesn't even seem to have the right share count here. And so there's just a tremendous amount of poor modeling and poor sell side coverage here with analysts really struggling to justify prices. I mean, even some of the recent analysts have said, oh, well, we're trimming our near-term estimates, but we're increasing our price target. Basically, what people are doing are shifting numbers out into the future. They're cutting numbers today and then increasing them in the future, just thinking, there's just some temporary headwinds here. Well, there might be some potential temporary headwinds on the inflation, but some of these other longer term challenges we've talked about aren't going away. So
what do you think is driving that like 20 turn multiple gap between Stryker? Let's call it 10 to 20 turns. Like if this is at 30 times earnings, maybe the comps are 20 times earnings. You think it's more like 40 times earnings, but what do you think the market is missing here? And like, how did its multiple grow to where it got to without people, putting on the brakes and being like, wait a second, geez.
Well, look, Divya, I mean, you and I both know, having been in the banking M&A sphere, there's this sort of embedded premium to the roll-up here, that they're a proven acquirer and that they have a long runway for acquisitions. But I'm telling you that thesis needs to be rethought here based upon the recent acquisitions that they've done, which have come at a huge expense. I mean, they paid something like 12 times for Vocera. I mean, Vocera is a company that's been public for 10 years that never hit a single long-term financial goal, okay, that retracted its TAM, that had its CFO resign, whose CEO settled an alleged lawsuit for accounting manipulation. I mean, is this the best that they could do, is spend $3 billion for a Vocera walkie-talkie communication platform device? I mean, they even bought a company that Spruce Point warned about years ago called TSO3, a Canadian stock promotion. The stock went down 90%. We warned people that the product had poor commercialization. Stryker comes in and buys it. And then guess what? 7 months later, they say, oh, we're having problems scaling it. Really? Did I not lay that out for you in a pretty detailed report? So, I mean, anyone who thinks that these guys are great acquirers, I really think needs to rethink that thesis here. And that's why, we've argued in our deck that the multiple has to shrink here. The targets are fewer. As they're bigger, they need bigger targets. The targets that are of high quality are extremely expensive. Management has shown numerous times now that they cut expectations after they buy because they're overly optimistic. Their cost of debt is going up. Their long-term bonds are trading down 10%. So if you're a debt-focused acquirer and interest rates are rising, your multiple should come down for that. I mean, there's just a litany of reasons here that eventually, this multiple is going to compress. The stock at best will go nowhere, and worst case, we think down 75%. We've called on the audit committee. We've written a letter to Harvard Business School dean who sits on the board, outlining our concerns about the financial reporting anomalies and the aggressive accounting. We just sent the letter today to the dean of Harvard Business School. We hope he does something. I mean, his job, he's in a precarious place. Not only is he responsible for educating the next generation of business leaders and showing that he can adhere to good governance, but also he's got to serve the duties of Stryker and the corporation there. And on the governance side, we point out that of all the problems Stryker's facing, management got paid a record amount in 2021. Not only did they get paid, the CFO got a off-cycle retention bonus. What does he need to be retained for? Is he looking to jump ship? I mean, what's going on here? There's a huge disconnect between what's happening in reality and how management is making out with record pay.
Yeah, I mean, the HBS connection is a fascinating one because, I mean, he's going to go back and do a case study on this, and he's not going to want it to be like, this is how we, siphoned millions of dollars from shareholders. It's going to be an awkward conversation, if this thing doesn't work out as planned for them. What would you say from an inflation standpoint? I mean, obviously, inflation is dominating headlines. It's rattled the markets. I'm sure you saw the Fed minutes and the comments from Lyle Brainerd yesterday. There's no question that short-term rates are going to be rapidly increasing throughout 2022 and going into 2023. Is there any rational reason why market investors should sort of give healthcare or medical devices as an industry a pass, as being somewhat insulated from the cost of capital going up?
No, absolutely not. Again, I think there's this embedded M&A premium in this name, this roll-up premium, but then there's also this embedded view as it being a defensive industry, right? Healthcare. But as we pointed out, 50% of sales are tied to basically consumer discretionary procedures, right? I mean, the patient decides, do I want this procedure or not? If I do, then a Stryker, surgical implant could be used. So yeah, I mean, I think the premium warranted to this industry is excessive right now. There's clearly a shift out of riskier technology businesses into maybe slightly less riskier medical technology businesses, which, look, Stryker does generate cash flow. Obviously, we've targeted other technology businesses that don't generate cash flow, that burn a lot of money. But the multiple's pretty high here. And so investors, buying into the story here, again, we just, warn that there is compression. There is tremendous amount of multiple compression risk here.
What would you say are the biggest catalysts in the next 6 to 12 months for this name?
Earnings. I mean, I think the company has got to come clean here. I mean, it's very obvious they've been dancing around the impact of the supply chain issue and inflation on margins. And we laid it out on a slide. I mean, in November, they were saying, oh, everything's fine. We've got everything under control. And then in January, they kind of came out and, said, hey, we might have a 50 to 100 basis point gross margin impact. And then at a conference recently in March, I think the Cowen conference, management said, well, it might be at the high end, and then the stock sold off quickly to 240. And then what you saw was the analysts coming out saying, oh, no. There's been some miscommunication. Management may have just miscommunicated. They're not cutting guidance, right? They're very confident that, if there's any short-term hiccup, that the back half of the, you know how many times we've heard this, oh, it's going to get better in the back half of the year. Well, again, we are now 2.5 years into this COVID, and it's lasted a lot longer than people thought. It's wrecked more supply chains than people thought. It's caused more inflation than people thought, and it continues to linger. Now we have a global war, or if we have a global war, if the Ukraine situation escalates, there's all sorts of risks here to the narrative that the back half of the year is going to somehow be better than the front half of the year. And so what's the catalyst? I think management needs to just come clean, just cut numbers, reset expectations, have the stock reflect fair value, and move on.
And would you say the biggest risk to your thesis is this a potential lift if elective surgeries do come back in force maybe that helps the top line and the margin pressure.
Sure, but I mean, how is it not already priced in at 6.5 times revenues, right? I mean, number one, look, I see very little. Why do I also like this as a short? As I said, it's low, it's not crowded. But number two is what's the takeover risk here? Who's going to come in bigger and swallow Stryker? I think there's very few companies with the capital and the inclination, particularly after all this due diligence we've done, that can really come in and buy out the whole company. So I see very little takeover risk here. I see very little upside to estimates. I see way more downside than upside. To me, it's very asymmetric. The stock, again, the analysts, if you take the consensus of all the analysts on the name, they're projecting $281 a share average consensus. The stock's at 270. What are you hoping for? 5% upside? You have 5% upside, and you have potentially 75% downside if the cat comes out of the hat and the multiple compresses. Why would I ever want to take that risk reward, take that bet? Why would I ever want that bet?
Yeah, I mean, I think this is such an interesting story because it's such an old name. It's not one of these high flying technology companies trading at a 20 times sales multiple with negative earnings. Like, this company has built a reputation over a long period of time as being sort of the name in medical devices. I think it's interesting that in itself is maybe a cognitive bias that people are missing, right? Like, that they're wedded to, almost like when you look at a name like, any category leader, like whether it's an Apple or whatever, people get used to paying really high multiples for companies that have succeeded in the past, but they don't look at the forward picture as carefully. And maybe you're right. Maybe that's what's going on here, is that people are kind of giving them a pass without realizing that there's a structural change in the model, due to competition and also, what's going on from a cost standpoint.
Yes.
So
yeah, anyway. I think you got to look at the competitive. You got to look at the again, 60% of this company's allocating 60% of capital it raises and capital it generates to acquisitions. So go out there, look at the acquisitions, look at the space of public companies that are actionable, in the multi-billion-dollar range. It's the few and far between, and they're incredibly expensive. And Stryker, to continue to play this game, they're going to have to pay up. They're going to put more leverage on their balance sheet, and it's going to get, all it takes is one deal to entirely blow up, and the story's over. And look, we think it could be the Visera one they just completed. Why? Because they literally bought a walkie-talkie device whose technology Microsoft owns. So Microsoft bought Nuance, okay, which is a speech technology company, and Microsoft now has the backbone for that Visera device. And Microsoft has been making its own play into the healthcare market. And what's to stop Microsoft from saying, "Hey, we're not going to license to you, Stryker. Sorry, we want to roll out our own Microsoft tablet to all nurses, and it's going to have, the Visera. It's going to have the Nuance technology. And sorry, Stryker, but we're just not going to license that to you anymore." I mean, that's a real risk. They just dropped $3 billion and took $1.5 billion of debt out for that. So buyer beware here. There's a lot of risk to this story that we think is underappreciated.
Yeah, I think we can end on that. That's a pretty comprehensive look at what's going on here. Thank you again for taking the time. I'm going to be watching this one. I feel like I've been watching Stryker for so many years. I actually personally owned it for a couple of years back in the mid 2000s, but then sold out eventually. But thanks again. We'll follow up with you on this and see how the story pans out.
Great. Well, it's always a pleasure. Thanks to you, Divya and SumZero, and we'll look to reconnect on the next idea, and we'll see where we are with Stryker 6 months from now.
All righty. Thanks, Ben.
Okay. Take care.